Welcome to TradeTheNBI.com. This is John. This report is for the 29th of March, and well, we're getting some nice activity intraday, albeit yesterday there was a little bit of sloppiness, but not unexpected given the extreme ranges. But we're still supporting right down here at this baseline. We've had the complete reset of the DOC. We also started to see shakeout rising. Just now getting back to that negative 13.5 range, which makes up moves a bit more attractive. At the same time, you had orange below green, but not a full reset below the red, and you still don't have steel supporting on that. So we're not expecting a whole lot from where we're at, but that doesn't mean that it still isn't going to have some nice little positive bumps. And again, it gets back to what we were talking about before from the, well, I took it off here, but we can add it back on there while we're there. The fib level retrace activated right there. And you can see beautifully that 23% line, which is at the 26.16 and a half. Hasn't changed. And like I said, above that, safe to be long. Below it, not so much. Quick and easy, simple. And you can see NQ has been a little bit better, but yet performed a little worse, at least from its reading standpoint. So, but still no difference. Same concept right here, that even in a pop, you don't have the reset of the proper elements to support a long-term move. So within the downturn that has existed, we're still in that with some positive bias inside of it. So that makes for more intraday kind of setups. Here we're looking at the fade of the euro coming back, so it's getting more back into line. This has just been some really pathetic movement from it, but it's kept it within the range at this higher level. And there's going to be a drive to want to drive that lower because it's really starting to have negative impact for trade, particularly German trade when it comes to automotive, that kind of thing, and that is something they're very sensitive about. The flight to quality and the safety issue has spiked, and also the concerns that potentially you're not going to see the levels of inflation that have been anticipated. That is ramping up very quickly, so that has caused a little softness in gold. Oil, though, is going to be the factor. It's going to mean, higher prices down the road. And while that should be reflected in gold, in that you're not quite seeing it yet, we had the positive extremes. Those got filled back in place pretty quick here. And we ended up with a sharp reversal here just in the last. And this is where the ETFs are a little slower than where the futures would be. The futures, we can see that happening much earlier from the original move. Thought I'd throw this one in here because remember it was that Bitcoin going to $1 billion, and it may still do that at some point. But we had seen from a daily standpoint the long-term chart from that short up at 16,000 ranges. People always say, "Oh well, it's oversold." Well, it was oversold. They said at 12,000, was oversold at 10,000, was oversold at 9,000, 8,000. Here we are now 74. This is one of those beautiful things where oversold is only relevant if you've got a situation where there are new buyers coming in. And at this particular point, when we look at that from a daily standpoint, actually I could put up, I sort of changed the symbol temporarily for Facebook because it was interesting to watch that drop off as we saw the short setups develop several key points, each of the main decline modes. Well, this one was the first most dramatic, where we ended up with the DOC spread. You didn't get falling shakeout until this bar right here, and that led to the first series of drops. Of course, it was very convenient because, Zuckerberg, fortunately for him, was able to get rid of his, million plus shares, over $1 billion, early enough. Switching gears real quick from Facebook on that small interruption I had. Here we have the Bitcoin futures again, but 600 minutes, just simply because if I go to daily, there just isn't enough data to actually produce anything. But it shows, going back from the peak, how this has been a major downturn. If we actually use the fib level, we can just go and do a full regular one off that move. You can see that from the grand apex there to, it's been roughly about a 50% return and then fading off of that. So no shock. And then every key point at those 50% you've seen beautiful DOC spreads develop right in line with them. So the point being is, it just doesn't matter the instrument. It's just a question of, if it's traded on a major open market, it's going to have algorithms attached to it because it can be easily exploited and it's profitable. And that's exactly why it's done and why it's easy to track. We're going to shrink the 5K chart because it was like a really kind of volatile, bouncy day per se. Is pretty much, it was just sort of like one of those, what I would call establishing an equilibrium. After you've had a major sell-off, usually you get these kind of performance days where accumulation and or additional distribution is taking place. So what we had was the major down move, and we tried to keep pressing the highs, and it was producing some beautiful, nice runs, both to the upside, to the downside. So you know that someone's picking up average weighted price somewhere around that 212 to 218 range. So just above and below what the 23% is, and it's attracting attention right below it, and also a little bit of selling. So someone looking for both ends of it is being able to acquire all within that. And you can see that so much action happens right around it. As we look at this entire day, it takes a while just to even scroll across it. But we ended up with some beautiful signals in the open ranges, but a lot of the expectation isn't much, because you're really just looking for a couple of zone move, in a lot of cases from a low to 50% or 50% to 100 once you get strong momentum on positive shakeouts, because we've had a lot of damage within the general shakeout readings. And you can see it here as we get into a little, this even squeezed as much as it is, shows you how much of a range bar that you were looking at with a lot of these moves. And you just had to be fluid with it. That was the trick with this one. It's a little bit tougher day because given within the bar ranges, stop-wise, you really have to utilize the zones, because if you're trying to go off an ABM or even long-short algo, it's not going to work. You're going to have, entering down here at a 23% break, you've got to be below the low. Well, the range between that, even if we're looking at this one at the end of it, it's a little bit tighter, but particularly when they get wide. Let's see what this one was right here when it first occurred. So you can look at the 23, it's a little over 6 points, right around 6 points, which is not horrible, but you're going to be slightly below the low of the day on that. But that just means from a risk-reward standpoint, you've got to be looking at least a good portion of that on your return. Now, in this case, the 50% was all the way up at 11. So even if you're entering at the 0.2 range, that's a decent return for that exposure. So there was plenty of movement that took place that justified some of the moves, and but you can see it's just a lot of chop. You'd be up a full zone, go down below a zone and a half, all within one bar. So not for the faint of heart. And if you're trying to trade with 2.5 point or 3 points, it's just not going to work for you. Not in this range of volatility. So you have to be adaptable to that. And this is why I've suggested using the Morganacci here, or the Bevel Retrace program, as a source to really identify beyond where the ABM is, because once you have that break below, in this particular case the ABM gets so far away from price, you know there's going to be a mean reversion to it, and then you have this huge massive gap between where the green ABM is and the yellow. I mean, it's significant, and so you have to respect some of the anomalies of where we are in the time of this trading. And I don't expect it's going to change. You're seeing a real question mark as to what's going to happen with a lot of these tech giants particularly as it becomes known that they've essentially been massive spy networks, which is kind of comical when you think about it, because at the end of the day, we've all known who the initial backers of these businesses were from way back, and so none of it's a surprise, and all of them have contracts with the federal government anyway, so there's some stability built into them, but whether the public will continue to accept it becomes the interesting one. It doesn't seem to have been an issue in the past, but maybe people are becoming a little less comfortable knowing that Facebook can turn on their microphone and or listen to any conversation or view their camera anytime they want. Maybe there was a little fine print that people didn't pay attention to that they will now. So that's where some of that tech stuff is going to be problematic. You're probably going to see it in Google next, Twitter as well. And Amazon, of course, has the president complaining about the antitrust issues and the non-equitable playing field, which completely makes sense given his position on trade and wanting more equitable trade, because regular brick and mortar can't compete against the online subsidies that Amazon is receiving, both in postage as well as not necessarily having to have a brick and mortar location. So that's all irrelevant to what we're talking about from the trade standpoint. You can see that we've been trending now more towards a little bit more positive shakeout, which suggests that we might see continuation of the move. We ended up at the softer side of the end of the day rally right here, and then in pre-market that's continued. It popped up, retraced, filled it all back in, saw the positive extremes from there, been taken out from that standpoint, and the new buys have been coming up at a little bit higher zones. So we barely got the oversold. A beautiful signal right there at the end of the day, popped up. It filled it all back in, and then we ended up with a similar DOC spread right as this one got really choppy, moved all the way down, and then new reset that took place. And then it got to 50%, and it's exploded from the 50 to the 100 on falling highs, but flat low. This is a little bit more awkward because you're not seeing a steady descent in the highs, so it's sort of like at the peak dip you're getting the activity. In this particular case happened there under falling shakeout and right at a DOC spread, so that became problematic for it to hold that one, but it still has taken it right back to it. But who's going to have that kind of a range other than someone like me, who will just not the stop in place until I actually do it, because despite what they say, it just seems that when you have a significant number of contracts and they can see the orders, somehow they manage to go right to those spots. I've always avoided that once you get past 10 or more contracts, it tends to be that way. So it's neither here nor there, as long as you're active with it and you're not leaving it by itself for extended periods of time, you can do that. Right now we can see that we're just getting to a little peak out point here. Magenta's forming, but we're still on rising shakeout. You can see steel dipping below, and I can enlarge this now that we've gone over some of those, and you can see how ugly the candles are, but the direction still is being accurately depicted with the rising shakeout, even though you're getting dramatic moves within the candles. So that's the long and the short of it. I'll continue to keep you updated and post as needed, and we'll be getting together the indicators for April, so be ready for that. As always, trade well.